Welcome to our video on the relationship between interest rates and currencies in the Forex market. As traders, it's essential that we stay up to date on all the different factors that can impact the demand for a particular currency. Interest rates are definitely one of the most important ones to consider. So let's start by explaining what interest rates are. Essentially, they refer to the cost of borrowing money and are set by central banks, like the Federal Reserve in the United States. These central banks use interest rate policy as a tool to manage the overall level of economic activity in their respective countries. When interest rates go up, it becomes more expensive for individuals and businesses to borrow money. This can help slow down the rate of economic growth and curb inflation. On the other hand, when interest rates go down, it becomes cheaper for individuals and businesses to borrow money, which can stimulate economic growth and potentially lead to higher inflation. Now, why is this important for traders like us? The demand for a particular currency is closely tied to the interest rate set by its central bank. When interest rates are high, it can increase the demand for that currency. This is because investors are attracted to the higher returns that higher interest rates can provide. If the interest rate in the United States is higher than the interest rate in Japan, investors may be more likely to hold their assets in US dollars, which would lead to an increase in the demand for the US dollar and a corresponding appreciation in its value. On the other hand, if the interest rate in Japan is higher than the interest rate in the United States, investors may be more likely to hold their assets in Japanese yen, which would lead to an increase in the demand for the yen and a corresponding appreciation in its value. But it's not just about the current interest rates, it's also about expectations for future interest rates. If investors expect interest rates to go up in the future, they may start buying that currency now in anticipation of the potential returns. This is known as an anticipated interest rate differential. For example, if the central bank in the United States is expected to raise interest rates in the near future, investors may start buying US dollars in anticipation of the higher returns that the higher interest rates will provide. On the other hand, if the central bank in Japan is expected to lower interest rates, investors may start selling Japanese yen in anticipation of the lower returns that the lower interest rates will provide. But it's not just about interest rates, there are many other economic, political, and social factors that can impact the demand for a particular currency. For example, the overall strength of the economy can also impact demand. If a country has a strong and growing economy, it can lead to an increase in the demand for its currency. This is because a strong economy typically leads to higher corporate profits, which can attract foreign investment. On the other hand, if a country has a weak and contracting economy, it can lead to a decrease in the demand for its currency. This is because a weak economy can lead to lower corporate profits and less foreign investment. Political stability and the level of government debt can also impact the demand for a particular currency. If a country has a stable political environment and a low level of government debt, it can lead to an increase in the demand for its currency. This is because investors are more likely to feel confident about holding their assets in that currency. On the other hand, if a country has a volatile political environment or a high level of government debt, it can lead to a decrease in the demand for its currency. This is because investors may be less confident about holding their assets in that currency due to the increased risk. So, how can we use this information to our advantage as traders? By developing a solid trading plan, we can make informed decisions about when to buy or sell certain currencies. A good trading plan should include a clear set of rules for when to enter and exit trades based on market conditions and your own risk tolerance. It should also include a risk management strategy to help protect your capital and maximize your returns. And it's important to continually review and update your trading plan as needed to stay up to date on the latest market trends and news. In addition to having a trading plan, it's also important to be disciplined in your approach. This means sticking to your plan and not letting emotions or impulsivity cloud your judgment. A specific model or strategy can be particularly helpful in this regard. A model or strategy is a set of rules or guidelines that you follow to help make more objective and informed decisions. It can help you determine the likelihood of a particular trade being successful based on past performance and other variables. Having a precise trading plan and specific model or strategy can be the key to consistently profitable trading. It's important to continually review and update your plan and strategy as needed and to stay informed about the various factors that can impact the market. By doing so, you can fine-tune your approach and increase your chances of success in the Forex market. Thanks for watching our video on the relationship between interest rates and currencies in the Forex market. We hope you now have a better understanding of how these factors can impact your trades and how to develop a solid trading plan to maximize your profitability. Stay tuned for more valuable insights and tips on the Forex markets. Happy trading!